Welcome everybody again. I've muted everybody, just make sure that you're on mute. And if we have some problems with mute, I can, we'll have, we'll address that as the presentation goes on. Everybody can see each other's names in their, video, which is fine. Most of the folks, or some of the folks know each other, which is great. Messaging is enabled. And I've done some security stuff, so hopefully no one's going to try to share their screen. And we'll save questions till the end for this one. Some discussion points. Some discussion points. So we'll talk about some historical data, some perhaps misconception or misremembering some market behavior, and then some closing points there at the end. What you won't hear today from me, anything about political viewpoints or predictions about who's going to be victorious in the election. As I told you before, professionally, I'm apolitical. Necessarily my firm, we have to touch and address on legislative impacts as a result of the elections. But as for any kind of stances or endorsements, whatever, that's not part of the deal. So first, we'll talk about some presidential election data. So we'll cover a period from about the early part of the last century up to the current day. And we'll talk specifically about S&P 500 market returns. So in that period, you saw 23 presidential elections. Average return per year, about 12% on non-election years. And in election years, the average return was roughly a little bit over 11%. No absolute explanation for the disparity in the performance there. One consideration might be the uncertainty that surrounds elections, but the data simply isn't hard enough to say that there's one specific explanation for that minor disparity. Potential election results. So when we talk about presidential election results, either the presidency can stay within the same party, or you can transition to a different party in our two-party system. So when the presidency stays within the same party, the average return is quite high, 16%, while when it changes parties, the average return reduces to about 5.14%. So a good place to start in explaining this disparity is with the economy, because typically that has a very large impact on the election results. So the current economic trend going into the election has a large influence. You remember back in the Bill Clinton campaign, it's the economy stupid. So that's why you see perhaps a large disparity when the presidency changes parties, because there might be something, might be in a recession or some other economic impact related to people's employment or some other factor that's making it difficult on the incumbent. Okay, and a very real example of that was the first President Bush. So February 1991, after the end of the first Gulf War, his approval rating, almost the highest on record, only exceeded by his son after the second Gulf War, or after 9/11. 89%. Just over a year later, approval rating with the economy in recession, approval rating goes all the way down to 29%. And then, of course, as we know, the result of the election a couple months later, he was voted out of office by losing the election to President Clinton. Okay, so then two-party system results with Republicans versus Democrats. So from the period from 1926 to the current day, there's been a Republican president for 46 years and a Democratic president for 48 years. When a Republican's been in office, the average return has been about 9.12%. When a Democrat's been in office, the return's been about 14.94%, which might fly in the face of conventionalism for some folks. Some notable examples within that space: President Coolidge enjoyed about a 31% return per year while he was in office. President Hoover had to deal with the beginning of the Great Depression, so his returns were quite poor. And of course, President Clinton, benefactor of the rise of the internet age, so he enjoyed very large returns while he was in office. Okay, so another impact that one may think on stock market performance is who is in control of Congress. So there's, in our two-party system, there are essentially four results that, or four configurations we can have of our White House coupled with the Congress. One is to be unified within the Senate and the House and the White House. as Republican or unified as Democrat or divided with either Republican or a Democratic president. So I'm not gonna do any polling, but if I were to poll, I would imagine that the results of a large group of people for polling for stock market performance would look something like this. If the government was unified with one party being Republican, the stock market deregulation, good for business, market performance would be really good. And the converse being true for the Democrats. And then for split with a Republican or Democratic president, then the tie goes to the Republican because of the same methodology above. But in reality, the actual results are quite different. So when we've had a unified Democrat or unified Republican government, the stock market returns have been essentially the same, about 14.5%. Divided with a Republican president, returns have been about 7%, and divided with a Democratic president, returns have been about 15.94%. So if you were basing your vote in a couple weeks here, or a couple days here, solely on stock market returns based on historical data, what you would want to do is maybe vote for Vice President Biden and hope that the Senate was retained by the Republicans. Of course, historical performance says nothing about the future. So this is just to draw some examples of what might be a misconception amongst folks about the occupants of the different offices. Okay, some other misconceptions. So sometimes I've heard some folks send emails, have conversations with them about broad generalizations made. For example, Democrats are bad for business. Republicans are good for business, deregulation, whatever. So if you're going to do that, it's important to get the history right on what you're basing that kind of a statement on. So I want to give a couple of examples there. So first one is President Carter, generally regarded as a poor president for the economy. However, history said, or the results were quite different in that his actual job gains while he was in office trended well above the World War II trend line, which he is not given substantial credit for. Similarly, when Obamacare was passed, the convention of wisdom said that inflation across all sectors of the economy based on increased medical costs for employers was going to cause rampant inflation for the economy. Well, in reality, the CPI, as a measure of inflation, the Consumer Price Index, tracked well below the post-World War II trend line. And then lastly, for President Trump, when the Tax Cuts and Jobs Act was passed in 2016, came into effect in 2017, the expectation was that capital expenditures, as businesses had more money in their pocket, was going to increase dramatically, when in fact, capital expenditures while he's been in office have tailed off quite substantially. This is pre-COVID data. So the idea here is to know exactly what the facts are to base generalizations. And the other sort of minor takeaway is that the president has much less impact on the economy and the stock market in particular than what is generally perceived. Okay, so getting over to the sort of the meat of today's discussion, which is market behavior as relates to elections. So if you've written anything I've read anything I've written before, the stock market is a complex system. So before we get into that, we'll talk about a very simple system. Okay, take my stove at home, for example. Very, very simple system with only one input, the knob. So if I turn the knob on, flame goes on. That's really the only impact to the system. Conversely, we talk about something like the stock market. There's multiple inputs into the stock market. Some independent, some are dependent. For example, you've got interest rates, you've got monetary policy, fiscal policy, geopolitical concerns, and then just unknowns that we can't possibly predict. And of course, one of the bigger ones that always hangs over the market is the human emotion. So This type of system is not given to predictive data. Conversely, something like chemistry, physics, we can plot a course to the moon or to Mars. We know how to get there. All we have to do is have the equations necessary to make that judgment, and then we can set that in motion. The stock market is completely different. It doesn't lend itself to those sort of calculations. As an example of how the human emotions can sort of weigh on markets, you can go back to the election of 2016, and you saw when going into the election night, generally was expected that candidate Clinton was going to become President-elect Clinton on that evening of November 8th. Early into the night, or later on in the night, it became apparent that President Trump or candidate Trump was going to actually be victorious. And when that happened, the S&P futures, which predict where the market's going to be on the following day, dropped precipitously by 4% on election night. Then the next day, on the first trading day that we had a President-elect Trump, the S&P 500 closed up 2%. So that 6% disparity or range of the election or the market performance in one day is very unusual and probably very emotionally driven. And that had nothing to do with the economic futures of the components of the S&P 500. It was very unlikely that the economic prospects of McDonald's or Starbucks or Home Depot or whatever company you want to pick was going to have such a broad range in a matter of what essentially was 12 hours. So this is just an example of how things can get really wacky with the market and how it's more of a complex system than is perhaps appreciated. Okay, couple points to close with here. The first is it's very, very important as an investor who's a long-term in nature to stay invested in the stock market. This is some historical data, again, not promising anything about the future, that starts essentially on January 1st, 2005 and goes all the way through the end of 2019. So if you started with a $10,000 investment on New Year's Day of 2005, and you stayed fully invested all the way through to the end of 2019, your $10,000 grew to $36,000 plus. Conversely, if you missed only the 10 best days in those 15 years, your return went from a 9% annualized all the way down to a 4.13% return. That's only 10 trading days. There's about 252 trading days per year. So the 2,520 days that that market was open over that, 252 days per year for 15 years, the market was open. If you missed just the 10 best days, your returns were essentially cut in half. Similarly, if you missed 20 days, then your return was further reduced to just over 1%. You missed the 30 best days, your returns were reduced to negative, and you missed the 40 best days, you were decidedly negative by almost over 3.5%. So the takeaway here is it's essential to not try and time the market based on macro predictions like elections. Okay. So as a very real example of that, outside of this data set, but very applicable to the folks who are current clients, is March 24th, 2020. On that date, the pandemic had already been identified and started to feel the force of it here in the United States, with lockdowns, shutdowns, restaurants, and other businesses being forced closed by local governments. Well, the market had taken quite a few lumps, but the prices had gotten to a point where investors had said that there was perhaps some potential in the America Inc., despite the negative impacts to COVID to that point. Well, on March the 24th, 2020, in that one day, the market was up 9.4%. Let me say that again. In that one day, the market was up almost 10%. Okay. So it's very important to realize that you just cannot be out of the market on days like this. So if you are contemplating zigging and zagging out of the market, you run the risk of missing days like this. And if you do, we've already seen that the impact to your investment performance can be drastic. So again, not recommended to try and zig and zag out of the market based on what your feelings are, because typically when you do that, it's guided by emotion, which is a bad thing to introduce into your investments at any time. Politics and investments. If you invest a lot into what people like Warren Buffett says, which of course I do, he says it's a big mistake to mix politics and investments. And why is that? We've already seen that the occupants of the White House and the Senate and the Congress have much less of a dramatic effect on stock market performance than is generally appreciated. So if you are looking to vote for a candidate based on how your stock market portfolio is going to do, that's probably going to leave you with a disappointing result. Now, that said, I think it's important to appreciate that we have a democratic process. And if you think there's a candidate that you place a great deal of trust and like his or her agenda on whether they want to take the country or your municipality, by all means, vote that person into office. However, I would keep your investing strategy independent of that candidacy. Okay, so I've said what not to do. What's important? It's important to reiterate what you should do, in my opinion. These are the 7 cornerstones I've identified before, and anybody who works with me knows that I emphasize these things every time that we meet, because these are the 7 cornerstones of what I think are a cogent financial plan. The first one, of course, have an estate plan. Maintain and establish and maintain your emergency fund, mitigate your financial risk with insurance, stay current on your taxes, have an executable budget, contribute to your retirement accounts and to your other savings if you're able, and address your long-term care needs. Now, if you look in here, I've said nothing about monetary policy, fiscal policy, polling, whoever's agenda, for the candidates, make an evaluation of that. Your stock market portfolio will take care of itself over the long term. If you do these 7 things, and everybody's situation is unique, so there might be a couple others that are tangential to this, then your portfolio is going to take care of itself. And if you do these things, it's going to keep emotion and reactivity at a minimum so that you can let market volatility work in your favor, as I said before, about March 24th of this year, and you can go forward onward and upward and achieve your financial goals. Okay. So this time it's different, heard frequently in the media. So Spanish flu versus COVID-19. So I'm not going to talk about numbers related to infections back in 1918 versus infections today or the impact. I'm not an epidemiologist. I'll just say that pandemics that we're experiencing today are not completely new, in that we've seen this kind of thing before, and we've had to deal with, the economies had to deal with a pandemic previously. So this time is not necessarily different, although the impacts we've had have been somewhat unique. Similarly, if you can remember back, talking about some of the local political uprisings we've had, back in 1786, nearly 10 years after the country was founded, we had our first armed rebellion to try to overthrow the government. So, from there, we've seen many different things of a similar stripe. So that, again, not necessarily new either. Contested election. Some people are concerned that the president's going to reject the results of the election, and things are going to happen that are going to be very disconnecting with the stock market. Well, if you go back to the election of 1824, Andrew Jackson actually had the most popular votes and the most electoral votes, but didn't have a majority of either. So the election actually had ended up going to a contingent election was held, Now the election was actually on December 1st before they changed the date, and the contingent election was held on February 5th. So that was a disparity of about 2 months plus. So, and as we know, John Quincy Adams was elected in the House of Representatives in the contingent election via the 12th Amendment. I won't bore you with any more of the details. My point is that we've had contested elections before, and we've had results that have come long after the actual election night. If you remember back to the election of 2000, President George W. Bush eventually defeated Vice President Gore much after the election night. So you might see or hear, read some things about contested elections and results not being on that night. And that might introduce some uncertainty into the market. That's true that might happen, but it's nothing that we haven't seen before, and it would seem like it's unlikely to have a permanent impact on anybody's portfolio. Of course, anything can happen in the short term, but my point is I wouldn't recommend making portfolio changes based on the possibility of there being a contested election. Okay, and then lastly, quote, newspapers are filled with all the invective, disappointment, ignorance of facts, and malicious falsehoods that one could invent to misrepresent my politics. If I had to take a poll of who said that, probably no one would have guessed that was actually President George Washington back in the day. Wise man, great man. However, he could not have possibly foreseen that the character limit would have been reduced to 140 in the future. So his sentence here is summed up in the current day with fake news by the current occupant of the White House. So the current occupant of the White House being somewhat unhappy with the media is, again, nothing new that we haven't seen before. Okay, the closing remarks. So when I think about presidents, I'll give you some ones that I consider to be great. First one, President Lincoln, saved the Union. Second one, President Kennedy. If you read about the Cuban Missile Crisis, we were very, very, very close to Armageddon, and he guided the country through that crisis. So in my book, that puts him in the great category because he saved essentially the world. Lastly, President Reagan won the Cold War and restored confidence within Americans that I think persist to the current day. So in just the short comments I made about all these past presidents, none of them, if you forced me to, I could probably go back in time and find out what their economic policy was, what their fiscal policy was, who was in their cabinet, how they were perceived by the media, how they worked with the Congress. But all the things that people think are impactful at the time, as time goes on, those things fade into memory, and it's really the test of time is the one that really counts. And things that people think are going to be impactful on their stock market portfolio, when you look back, it doesn't even really come into their mind about what was going on at the time, because markets tend to trend upward and to the right, and politics, especially presidential politics, have much less of an impact in the long term than what people think. So the takeaway here is not to let your political views or near-term things that we think might happen cause you to make drastic and substantial changes to your investment portfolio. Okay. With that, I will